Welcome to today's session, where we are diving into how to read market profile charts. These are powerful tools that help us understand price action, spot trends, and identify important levels in the market. By the end of this session, you will have a solid understanding of how to read market profile charts and apply what you learn to your own trading. Ready to get started? Let us go. Have you ever wondered how you could get a deeper understanding of what is happening in the market beyond just watching price move up and down? Imagine having a tool that not only shows where the action is, but also gives you insights into the market's true structure. That is exactly what a market profile chart does. It allows you to see where buyers and sellers were the most active, which gives us a clear picture of how the market is structured. By using this, you can identify important support and resistance levels. It also lets you see balance areas where the market was stable and imbalances where the market moved quickly. For instance, balance areas are when prices cluster around certain levels for extended periods, showing us zones of consolidation, while imbalances are where prices move swiftly, showing us where buying or selling pressure took control. Additionally, market profile charts help identify specific patterns such as trend days, double distributions, elongated profiles, P-shaped profiles, and B-shaped profiles, each of which provides unique information about the market's intent. Let us expand on these patterns. Trend days are when the profile stretches in one direction, either up or down, with little retracement. This indicates a strong directional move, often accompanied by increasing volume. Trend days can signal that the market is experiencing a fundamental shift, and traders should pay attention to follow through in the coming sessions. Double distribution profiles are when there are two distinct areas of high volume within the same session, separated by a lower volume area. This means the market initially balanced at one price level, but then found new information or pressure to move and balance at a different level. The area in between often becomes a key area to watch, as it represents a rejection zone. Elongated profiles occur when the market has a directional bias, but instead of moving sharply, it gradually grinds up or down. This profile indicates sustained interest in a direction, but with slower momentum compared to a trend day. This can often happen in a trending market where buyers or sellers remain in control, but without aggressive movement. P-shaped profiles indicate short covering. This means that traders who are holding short positions are buying back to close their trades, which pushes the market higher. Most of the volume is concentrated near the top of the profile, indicating a strong upward move, but with little follow through beyond a certain level. This can signal a temporary uptrend, often after a market has been oversold. B-shaped profiles indicate long liquidation. This means traders who are holding long positions are selling, which pushes the market lower. Most of the volume is concentrated near the bottom of the profile. This kind of profile often signals a bearish market, especially when traders are losing confidence and are exiting their positions. Understanding these patterns gives you a clearer sense of when the market is balanced versus when it is trending or experiencing strong directional movement. By recognizing these profiles, you can better anticipate market behavior, identify high probability trading opportunities, and make more informed decisions. This kind of insight can really give you an edge when you analyze price movements and plan your trades. Now, let us talk about the main parts of a market profile chart. These charts display the price distribution over a set time. When you look at the chart, you will see rows that represent different prices, and blocks or letters showing the time spent at those price levels. One of the most important things to understand is called the point of control. The point of control, or POC for short, is the price level where the most trading happened during that session. This level is often a strong area of support or resistance, which makes it crucial to watch. There is also something called the value area. The value area is where about 70% of the volume traded during the session. You can think of it as the fair value zone. Prices within this area are considered reasonable by most of the traders for that particular session. Then we have what is called the initial balance. The initial balance is the range of prices from the first hour of trading. This initial range can tell us a lot about whether the market will stay in a tight range or trend throughout the rest of the day. Now let us get into reading the profile's shape. A balanced market will look like a normal bell shape. If you see this kind of profile, it means that most of the prices are concentrated in the middle of the range. This suggests that prices are likely to stay around the value area unless something major changes the market direction. A bell-shaped profile is also known as a Gaussian distribution, representing equilibrium in the market where buyers and sellers are evenly matched. But not all profiles look like a bell. Sometimes you will see a double distribution. In a double distribution, there are two distinct peaks, which means the market shifted from one price level to another, rejecting one area and moving to a new spot. This usually suggests a significant change in market sentiment during the session, and the area between the two peaks often acts as a zone of low acceptance or resistance. Double distribution days often signify that the market has digested new information or undergone a revaluation, leading to the establishment of a new value area. Another profile type is the elongated profile. This occurs when the market has a clear directional bias but moves gradually. The profile will stretch in one direction with multiple price levels being tested, and it indicates a slow but steady interest in one direction, usually with sustained volume. Elongated profiles suggest that buyers or sellers are in control, but are not aggressively pushing the market. These profiles can often be seen during trending markets, where momentum gradually builds up over the session. Elongated profiles are useful in understanding where accumulation or distribution is taking place, as the market moves steadily without large swings. If you see a P shape, it might be telling you that the market is experiencing short covering or starting to move up. In a P-shaped profile, most of the volume is concentrated near the top of the range, indicating that traders who were short are buying back their positions, driving the price up. This pattern can often occur after a sharp downtrend where the market has become oversold and short traders rush to exit their positions, pushing the price higher. P-shaped profiles are often seen in bullish reversal scenarios, especially when initial bearish pressure gives way to stronger buying interest. Meanwhile, a B shape could mean the market is in a bearish trend and traders are getting out of long positions. In a B-shaped profile, most of the volume is concentrated near the lower end of the profile, indicating that traders who were long are liquidating their positions. This type of profile often forms after a strong uptrend when traders decide to take profits, and there is not enough new buying interest to sustain the higher prices. This can result in the market pushing lower, with significant activity happening near the bottom of the profile. B-shaped profiles are indicative of a bearish sentiment and are often seen in markets that are undergoing long liquidation. Another important profile shape is the Gaussian or bell-shaped balanced profile, where prices are distributed evenly around a central point. This balanced profile indicates that buyers and sellers are in equilibrium and there is no clear directional bias. In such situations, prices tend to stay within the value area, and the market may continue to oscillate around the point of control unless there is a catalyst for a breakout. Balanced profiles often appear in consolidation phases, where the market is gathering energy before a potential directional move. These periods are important as they often precede breakouts, providing traders with key levels to watch for potential entries or exits. Additionally, there is the trend reversal pattern, which can often be identified through a change in profile shape over consecutive sessions. For instance, if one day ends with an elongated profile indicating a strong uptrend, but the following day shows a B-shaped profile, this can signify that the market is reversing direction. Such transitions between profile shapes are crucial to understanding shifts in market dynamics and can help traders anticipate potential reversals before they become obvious on traditional price charts. By understanding these different profile shapes, you can gain better insight into market behavior. Each shape tells a different story about the underlying market conditions, whether the market is trending, balancing, or undergoing a significant shift in sentiment. By recognizing these profiles, you can better anticipate market behavior, identify high probability trading opportunities, and make more informed decisions. Another common shape is the elongated profile. This occurs when the market has a clear directional bias but moves gradually. The profile will stretch in one direction with multiple price levels being tested, and it indicates a slow but steady interest in one direction, usually with sustained volume. This pattern suggests that while buyers or sellers are in control, they are not being overly aggressive, which can still lead to sustained trends over time. If you see a P-shape, it might be telling you that the market is experiencing short covering or starting to move up. In a P-shaped profile, most of the volume is concentrated near the top of the range, indicating that traders who were short are buying back their positions, driving the price up. This pattern can often occur after a sharp downtrend where the market has become oversold and short traders rush to exit their positions, pushing the price higher. Meanwhile, a B shape could mean the market is in a bearish trend and traders are getting out of long positions. In a B-shaped profile, most of the volume is concentrated near the lower end of the profile, indicating that traders who are long are liquidating their positions. This type of profile often forms after a strong uptrend when traders decide to take profits, and there is not enough new buying interest to sustain the higher prices. This can result in the market pushing lower, with significant activity happening near the bottom of the profile. Another important profile shape is the Gaussian or bell-shaped balanced profile, where prices are distributed evenly around a central point. This balanced profile indicates that buyers and sellers are in equilibrium, and there is no clear directional bias. In such situations, prices tend to stay within the value area, and the market may continue to oscillate around the point of control unless there is a catalyst for a breakout. Balanced profiles often appear in consolidation phases, where the market is gathering energy before a potential directional move. By understanding these different profile shapes, you can gain better insight into market behavior. Each shape tells a different story about the underlying market conditions, whether the market is trending, balancing, or undergoing a significant shift in sentiment. By recognizing these profiles, you can better anticipate market behavior, identify high probability trading opportunities, and make more informed decisions. You might be wondering how to use this information to identify key levels. The point of control is one of the most critical levels. Because so much volume was traded there, the price tends to hover or bounce around it. It is like a magnet for the price. Then we have the value area high and the value area low. These two levels show the upper and lower limits of that fair value area we talked about. These levels are super helpful for spotting breakouts or reversals. There are also areas called single print zones. These are places where price moved really fast with little trading. When price comes back to these areas, they often act as support or resistance. Let us explore some strategies you can use with market profile. One of the simplest is value area trading. In a balanced market, you could look to buy near the value area low and sell near the value area high. The key is to wait for price action that supports your idea. Another strategy is to trade breakouts. If the price moves strongly above the value area high or below the value area low with good volume, that could mean a breakout is happening. Just make sure that there is enough volume to support the move before jumping in. Then there is a reversion to the point of control strategy. If the price moves away from the point of control but cannot find strong support or resistance, it is likely to come back to the point of control, which could give you a good entry or exit opportunity. Using market profile with other indicators can really boost your analysis. For example, you can pair it with moving averages to confirm trends. If price breaks above the value area and moving averages are trending up, this can be a strong buy signal. Volume profile is another great tool. If both the market profile and the volume profile show high volume at the same levels, this strengthens the importance of those levels. You could also use the Relative Strength Index, or RSI, to see if the market is overbought or oversold. If the RSI shows that the market is overbought while the price is near the value area high, that could be a sign of an upcoming reversal. Another useful pattern to watch for is divergence. Divergence occurs when the market profile suggests one trend but another indicator, like RSI or MACD, suggests the opposite. For example, if the price is making higher highs but the RSI is making lower highs, it might be an early warning that momentum is weakening even if the price looks strong. This can help you anticipate reversals before they become apparent on the price chart alone. Fibonacci retracement levels can also be helpful when used alongside market profile. If the price is retracing to a key Fibonacci level that aligns with a significant market profile level, such as the point of control or value area, it can reinforce the likelihood of a reversal or a bounce at that level. This confluence of multiple indicators can increase the confidence in your trading decisions. You can also look at Bollinger Bands together with market profile levels. If the price is reaching the upper or lower Bollinger Band while also nearing the value area high or low, it could suggest an overbought or oversold condition. This is especially effective in a ranging market, where price tends to oscillate between bands. Another effective tool to use with market profile is the Moving Average Convergence Divergence, or MACD. If the MACD line crosses above the signal line and the price is moving above the value area high, this can provide a strong confirmation of an emerging uptrend. On the other hand, if the MACD crosses below while the price moves below the value area low, it could confirm a bearish trend. Finally, do not forget about candlestick patterns. Watching for key candlestick formations at significant market profile levels can offer a good indication of the market's next move. For example, if a bullish engulfing candle forms near the value area low, it can be a strong signal for a potential upward move, especially when combined with a point of control nearby. Similarly, bearish reversal patterns, such as shooting stars or evening stars near the value area high, can provide good setups for short positions. While using market profile charts, there are a few common mistakes that you want to avoid. One of the big ones is ignoring the point of control. Because it is such an important level, ignoring it could lead to missed opportunities. Another mistake is reacting too quickly to small price moves outside the value area. You always want to wait for proper confirmation from both the volume and the price action before making a decision. It is also important not to look at only one session. You need to take multiple sessions into account to understand the bigger picture. This will help you avoid false signals and get a more complete view of the market. Let us also touch on risk management when using market profile. A good way to protect yourself is to set stop losses just beyond key levels like the value area high, the value area low, or the point of control. This way, if the price moves against you, your losses will be limited. It is also smart to adjust your position size based on the volume. When price is near the point of control or a high volume area, it tends to be more predictable, so you can take larger positions. On the other hand, in low volume areas, price can be more unpredictable. In these situations, it is best to reduce your position size to manage risk. Another important aspect of risk management is knowing when to step aside and not take a trade. If the market is in a state of low conviction, where there is no clear trend and profiles appear choppy without consistent volume levels, it may be better to wait for clearer opportunities. Patience is crucial in trading, as entering trades in uncertain conditions can lead to unnecessary losses. Additionally, consider using trailing stop losses, especially during trending conditions, to lock in profits as the market moves in your favor. This ensures you participate in the potential upside while still protecting your capital. Always keep an eye on your reward to risk ratio before entering any trade. Ideally, you want to ensure that your potential reward is at least twice the risk you are taking on. This means if you are risking 10 points, your potential profit should be at least 20 points. Market profile can help you identify areas with a good reward to risk setup by focusing on key levels like the point of control or value area boundaries, where price action tends to react more predictably. Lastly, always have a plan for scenarios where the market moves in a way you did not anticipate. Market profile helps you understand key levels, but markets can behave irrationally. By having contingency plans, such as setting alerts for significant levels or deciding beforehand how much you are willing to lose on a given day, you ensure that emotions do not dictate your actions. This kind of preparedness is what separates successful traders from the rest. Now, if you are trading intraday, you can use market profile on shorter time frames like 5 or 15-minute charts. These shorter profiles help you spot key levels for the day and can be super useful for making quick decisions. If you are a swing trader, you can use daily or weekly profiles to find bigger support and resistance zones that are relevant for the long term. The time frame you choose depends on your trading style, but the principles are the same. To sum up, market profile charts give you a great view of how price, volume, and market structure all come together. By focusing on the point of control, the value area, and the overall shape of the profile, you can spot trends, breakouts, and reversals more effectively. I encourage you to set up market profile on your charts and start watching the point of control and the value area closely. Combine these insights with other indicators like moving averages and the volume profile for even better accuracy. Market profile is a tool that can really help you understand the market better. Keep practicing with it, and you will find yourself getting more confident in using it to make trading decisions. If you have questions or thoughts as you work with Market Profile, share them. It is always helpful to talk through your analysis and learn from one another.